Welcome back to The Explainer. Today, we're taking a seriously fascinating look at the very foundation of our economy, unpacking exactly how money and credit shape the world around us. Have you ever really stopped to think about what makes a random piece of paper valuable, or how a single loan can either build a massive empire or trap someone in poverty? Well, that is exactly what we are going to break down today.
But before we get into the nuts and bolts of it all, I really want you to think about where your paycheck actually goes the second you deposit it. We kind of just imagine this massive Scrooge McDuck-style vault with our name on it, holding stacks of cash, right? Well, the reality of modern banking is vastly different, and it secretly powers almost every single aspect of our daily lives.
All right, here's the game plan for today's explainer. We're going to trace the journey from barter to banknotes, break down the actual business of banking, explore the two very different faces of credit, contrast formal versus informal lending, and finally look at how we can actually empower the unbanked. Let's get right into it. Section 1. From barter to banknotes, the evolution of money. To really appreciate modern banking, you got to travel back to a time before money even existed. Imagine you're a shoe manufacturer, and you just want to buy some wheat. In a barter system, you couldn't just run to the store. You had to cross your fingers, wander around, and basically pray you found a wheat farmer who not only had extra wheat, but who desperately needed your specific shoes. Economists actually call this a double coincidence of wants, and the absolute genius of money is that it completely eliminates that massive headache. It steps in as the seamless intermediate step. You don't need to find your perfect bartering soulmate anymore. You just sell your shoes for cash and then use that universally accepted cash to buy wheat from literally anyone. It's the ultimate medium of exchange. And it's wild to look at how this evolved over time. Go back 2,500 years, and folks in early India were trading cattle and grains, which eventually morphed into early punch-marked metallic coins. Fast forward to the 20th century, and we've got standard government-backed paper currency. But then November 2016 hit India like an absolute earthquake. The government suddenly declared all 500 and 1,000 rupee notes invalid overnight, a huge event called demonetization. To survive without physical cash, people literally leaped into the digital era, rapidly adopting internet transfers and QR codes through the UPI system. The whole landscape just completely shifted. Which brings us to Section 2, the business of banking, behind the vault. Now that we know what money is, let's pull back the curtain on the institutions actually holding it. And honestly, this next fact blows my mind. 5%. In India, banks typically hold only about 5% of their deposits as cash on any given day. That's it. If you deposit $100, they only keep about $5 sitting in the physical vault. They basically bank, pun intended, on the fact that we aren't all going to show up demanding our cash on the exact same afternoon. So since they're holding almost zero physical cash, they rely heavily on demand deposits, money you can pull out whenever you want, and systems like checks. It's an elegant dance, really. You write a check, the other person deposits it, and the bank just digitally moves the numbers around. Wealth gets transferred without a single physical banknote ever changing hands. But that leaves a massive question. What on earth is the bank doing with the other 95% of your money? Well, they're lending it out. And that leads perfectly into Section 3, the two faces of credit, success and risk. Banks do way more than just sit on our money. They act as a massive mediator between people with extra cash and people who desperately need it. But credit, it is a profound double-edged sword. On one side, you have incredible success stories. Take Salim, right? He makes shoes. Festival season rolls around and boom, he gets an order for 3,000 pairs. But he needs cash immediately to buy leather and hire extra hands. By snagging some working capital credit, getting a cash advance from a trader, and grabbing raw materials on credit, Salim knocks out the order, makes a massive profit, and pays everything back. In this scenario, credit is a total game changer. It literally builds wealth. But then you look at the complete opposite end of the spectrum. Consider Swapna. She's a small-scale farmer who takes out a loan from a local village moneylender to buy seeds and fertilizer for her groundnut crop. Everything's going fine until a sudden pest attack totally wipes out her harvest. Suddenly she can't repay the loan, the interest compounds, things spiral out of control, and she falls into a brutal debt trap. To get out of it, she's actually forced to sell off a piece of her own land. So for Swapna, credit didn't build an empire, it literally destroyed her livelihood. So why do we see such drastically different outcomes from the exact same act of borrowing money? It all comes down to the terms of credit. Think of these as the four pillars holding up any loan: the interest rate you're being charged, the collateral you're putting up, the documentation you have to provide, and the mode of repayment. And let me tell you, these terms change wildly depending on who's actually handing you the cash. This introduces our fourth section, formal versus informal lending, the credit divide. We're really looking at two completely different worlds here. You've got the regulated formal sector, your traditional banks and co-ops, and the wild west of the informal sector, moneylenders, traders, landlords. If you break down rural credit in India, the formal sector is strictly supervised by the Reserve Bank of India, which keeps interest rates reasonable. But here's the kicker. Even though formal banks handle about 61% of rural loans, a massive 23% of people are still trapped relying on unregulated moneylenders. These informal lenders answer to absolutely no one. They can charge sky-high interest rates, sometimes up to 5% a month, and can use incredibly aggressive, unfair tactics to get their money back.
And this creates a genuinely deep, systemic inequality. Just look at urban households. A staggering 54% of loans taken out by the urban poor come from these expensive, sketchy, informal sources. But if you look at the urban rich, only 17% of their borrowing is informal. A massive 83% of their loans come straight from cheap, regulated, formal banks. So the rich get affordable credit to build even more wealth, while the poor are forced to pay exorbitant interest just to keep their heads above water, leaving them basically nothing at the end of the day.
Which brings us to our final section, empowering the unbanked, self-help groups. Now, you might be wondering, if the moneylenders' rates are so crushing, why don't the poor just go to a normal bank? Well, because formal banks demand strict documentation and, most importantly, collateral, like a house or land. If you don't have collateral, the bank simply shuts the door. So how do we fix a system that's so obviously broken? Enter self-help groups, or SHGs. This is an absolutely brilliant intervention. You take 15 to 20 local women who pool their small, regular savings. We're talking maybe 25 to 100 rupees a week. At first, members borrow from this pool at a super low interest rate. But after a year or two of disciplined saving, the group itself can actually apply for a bank loan. And the bank lends to them without asking for traditional collateral, because the collective trust of the group acts as the guarantee. It completely short-circuits the traditional barriers to entry. And this is exactly why these kinds of innovations are absolutely crucial. There's a famous quote from Nobel laureate Professor Muhammad Yunus. He founded the Grameen Bank in Bangladesh, and he basically hit the nail on the head. He proved with over 9 million members that poor women are incredibly reliable borrowers. He says that if we make affordable credit available to poor people on reasonable terms, these millions of small people can add up to create the biggest development wonder. It's all about treating credit as a tool for genuine empowerment rather than a trap. As we wrap up today's explainer, I really want you to chew on this thought. If credit is literally the engine of economic growth, what actually happens to a society when affordable credit is treated as a VIP privilege for the wealthy rather than a fundamental right for everyone? The journey from trading cattle to tapping digital QR codes is amazing for sure, but until the terms of credit are fair across the board, our entire financial system is basically incomplete. Thank you so much for joining me on this deep dive into the fascinating worlds of money and credit. Keep questioning, keep learning, and I'll catch you in the next one.